Hello and good evening. How are you? I hope you guys are doing well. Okay, so let's start. And today we are going to start off again with the questions from the final accounts, and then we are going to move forward into this. So let me share my screen with you. So first question at the moment that we have is of the triage. So after preparing a draft statement of profit and loss before interest and tax for the year ended 31st March 2026, before any adjustments which may be required from note 1 to 4 below are given over here. So we have this trial balance over here. Then if you have the following notes over here, which the notes are 1, 2, 3, 4. Then we have a typical requirement over here, and that is prepare a schedule of adjustments required to draft the profit before interest and tax in the above trial balance, and to give that the profit or loss come of the triage company for the year ended 31st March 26 as a result of the information in notes 1 to 4. Then we have to prepare a statement of financial position of the triage as well at 31st March 26. Okay, so we have to create a schedule for adjustments, and then we have to create a statement of financial position over here as well. So if I talk about as far as the financial position is concerned, I'm going to go here. Okay, CDE, and we'll have it over here up to this point. Here we go. Merge, expand a bit. So this is the triage statement of financial position as at 31st March 2026. I'm going to put up the currency signs over here. We have assets, non-current assets. Leave 3 line, then write current assets. Then you have the inventory normally, and you can have the receivables. Leave 2 lines, then write total assets. Then write equity and liabilities. We have share capital, share premium, retained earnings, revaluation reserve. We have non-current liabilities. Then we have current liabilities. And then we'll have total equity and liabilities over here. Some cosmetic formatting of the underlining. Here, 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 and here. For total assets, we are going to have this double line. With this, let's have one over here scheduled. This is going to be more than enough. And here we go. This is triage. Schedule of adjustments for the year ended 31st March 2026. And this is how we're going to go. So it said that for the broad draft profit before interest and tax in the above trial balance. Now, so in the above trial balance, the draft profit for the year is 30,000 over here, or 30 million over here. So profit before interest and tax, 30,000 is what we are going to have over here. Now, as this is a question where we have to do the adjustment, so I'm going to straight away go into the workings. And for the workings, I will straight away go over here in the point number 1. Triage company issued $400,000, $100, 6% convertible loan notes on 1st April 20x5. Interest is payable annually in arrears on 31st March each year. Okay. The loans can be converted to equity shares on the basis of 20 shares for every $100 loan note on 31st March 2028 or redeemed at par for cash on the same date. An equivalent loan note without the conversion rights would have required an interest rate of 8%. The present value of $1 receivable at the end of each year, based on the discount rate of 6 and 8% are, we have the 6%, we have the 8% rate over here. So we have this interest payment over here along with this 6% loan note, which is shown over here on 40,000. This is something which is issued on 1st April 20x5, and we have this at 31st March 20x6. So this is at the start of the year. So obviously, we have learned this thing that if it's a convertible loan stock, we have to split it between the equity and the debt portion over here, right? So in order to do so, we'll have working on 6% convertible loan stock over here. Now, we are going to have the number of years, cash flows, discount rate, present value. I'm going to go into the thousands. Discount rate is going to be the, without the conversion option, is 8%, and the present value is again going to be into the thousands. Now, it's converted on 31st March 20x8. It's issued on x5. So first year is 20x6, 20x7, 20x8. Cash flows, which I'm going to get is 400,000, 6%. So that's going to be 400,000, 6%. So if I go, this is, okay, this is 40,000 over here. Okay, my bad. Yeah, $1 because these are the loan notes. Huh? Okay. So that's going to be 240 over here. I hope, no, 40,000, my bad again. 1 over 0. So this is going to be 2,400 over here. Okay. So the loans can be converted into shares or redeemed at cash. So technically speaking, next year I'm going to have this 2,400 over here as well. And if they are redeemed for the cash, then 2,400 plus the 40,000 as well. So in the third year, I'm going to get 42,400 over here. Discount rate I'm going to use is the 8% over here. So with the 8%, I have 0.93, 0.86, 0.79. So the present values are going to be this into this. Then I'm going to do the total over here. So this is going to be the total present value. We are going to have the carrying value for 40,000 over here. So balancing amount is the equity option. And that's going to be 40,000 minus this 2208, right? So this is what we are going to have over here, the equity balance. Then, as far as for the debt half is concerned, we are again going to have the number of years, liability at start, interest, total, repayment, and then liability at year end. Now, first year is the 20x6. Liability at start is 37,792. Effective interest rate going to be 8%. Total is going to be the sum of this. Repayment is going to be the 2,400. And then For the debt, the balance is going to be 38,415 over here. Okay. Now, if I go now, as far as the posting is concerned, I'm going to straight away go into my financial position is concerned. I'm going to go into my non-current liabilities. In the non-current liabilities, I will write 8% loan notes. That is 38,415 over here. Right? After that, I'm going to go into my equity options over here. Equity options are 2208. And then I will go into my profit before interest and tax, and I will say the effective loan note interest. I will go and I will minus 3023. Done? So that is how you are going to post the figures around wherever they are required to be posted. Okay. Now, second point, non-current assets. The directors decided to revalue the property at 66.3 million on 1st October 20x5. Traj company does not make an annual transfer from the revaluation surplus to the retained earnings to reflect the realization of the revaluation gain. However, the revaluation will give rise to the deferred tax liability of 20%. Okay. So we have decided to revalue the property on 1st October 20x5. Now, the point is, year end is 31st March, and we are revaluing the property on 1st October. October, November, December, January, February, March. It's been 6 months since revaluation. So we have an issue over here that we are going to have the 6 months depreciation over here. I'm going to go and work into property, and I will write properties cost. This is the balance which is given to us. So the property using life is 25,000 and 25 years, and the cost is 75,000. Okay. Less accumulated depreciation. Plant and equipment and lease property is 15,000 over here. So I will minus this 15,000 from here. Less depreciation charge, 6 months. 75,000 by 25 years into 6 by 12 is going to be 1,500. Then we are going to have carrying value at the date of revaluation. So we'll have this carrying value at the date of revaluation over here, and that's going to be 58,500 over here. Now, the fair value which they have decided is 66.3 million. So we have a revaluation gain of 7,800. One thing. Then we will have the depreciation charge for next 6 months. That's going to be revised value of property 66,300. Depreciation charge next 6 months, and that's going to be on the remaining life over here, right? Now we have this 15,000 over here, which shows 15,000 by 1,500. That's 10 years, right? So we have this not 10-year rather, this is the 6 months depreciation for the year. Oh, there's going to be 3,000 charge for the year because this is for the 6 months, huh? So I'm going to have 5 years over here, 6 months over here. So total expired life so far is 5.5 years. Now, remaining life is, original life was 25 years minus 5.5 is 19.5, right? Okay. So depreciation charge for the next 6 months is gonna be 66,300 by 19.5 into 6 by 12. 1,700. Carrying value at year end 64,600. That's gonna be over here. This depreciation is what we need. This depreciation is what we need as well. And this is the revaluation gain on which we are going to have the deferred tax adjustment as well. 7,800 into 20%. I guess this was the rate of tax, 20%. Yeah. So that's gonna be 1,560 as well. This is something we have to do the adjustment for as well. Now let's just start posting. First thing is depreciation is 1,500 and 1,700. So I'll go over here. Depreciation. I'll write total depreciation, or I can say depreciation property first 6 months. For the first 6 months, the depreciation is going to be 1,500. Depreciation property next 6 months, that's going to be 1,700. Then I have the carrying value 64,600. Okay, this is going to be the property working 2. Okay, done. Done? Done. So, and then we have this deferred tax complication over here. So we'll do this point when we are going to do the working for the deferred tax. Then it says the property is depreciated on a straight line basis. We have already done that. And plant and equipment at 15% per annum using the reducing balance method. Now I'm going to go with the plant and equipment over here. This is the plant and equipment. Cost. Balance given. So plant and equipment 72,100. Less accumulated depreciation 28,100. Carrying value at start 44,000, right? Then depreciation charge for the year, and this depreciation charge was 15%. Then we have the carrying value at year end 37,400. So these two we have to record 37,400. This is plant and equipment for Q3. Depreciation plant and equipment 6,600. Done? Okay. Then, point number 3. In September 2025, the directors of Triage Company discovered a fraud in total 700,000, which had been included as a receivable in the above trial balance and had been stolen by employee. 450,000 of this related to the year ended 31st March 2025 and the rest to the current year. Okay. The directors are hopeful that 50% of the losses can be recovered from their insurance over here. So, technically speaking, we have a fraud of the receivables over here, which we have to adjust in our accounts no matter what. And the frauds or the errors, if we have in the accounts, we have to adjust them in full. So, even if they are hopeful that 50% is going to be recoverable or something, we cannot show it into the accounting that the 50% is hopeful that it's going to be recoverable or something, right? We cannot record it up into the account until unless we are virtually certain about it, all right? So over here, what we have to do is, I'm going to go in working for receivables. I will write balance given. Trade receivables 28,000. Less fraud and receivables, that is for what? Where's the fraud? 700. So I'll straight away go here. I'll minus the 700. So balance at year end is going to be 27,300. I'll go over here. Yeah. 27,300. Right? Now, as far as the debit half is concerned, some is related to the current year, some is related to the previous year. So over there, we will simple debit the retained earnings. We'll debit the current year profit and we'll credit the receivables by 700. Now, it says 450 related to the previous year and current remaining in the current year, right? So in the 450, this will be just on the retained earnings and 250 is going to be adjusted in the current year. So this is what I have to do the adjustment in the current year over here, right? The current year adjustment is going to be over here. So I'm going to go in and I'm right fraud and receivables working for, and the current year profit is going to be adjusted by 250. Then I'm going to go in the retained earnings. I'm going to write balance given. If I see where is the retained earnings, these are the retained earnings, 3,500 just. Prior period fraud working for 450. So I'll minus from here. Profit for the year is going to be over here. Closing balance is going to be over here. Right? Okay. Fourth point is a provision of 2.7 million is required for the current tax on the profit for the year. And then we have the balance on the current tax. So we are going to have this text point over here. I'm going to go over here. Working 6 with the tax. Okay. That's going to be income tax account. That's going to be the deferred tax account. It says the provision of 2.7 million is required for the current year. So the closing balance is 2.7 million. Then the balance on the current tax and the trial balance is the under road provision. So I'm going to go here. Current tax is the debt balance of 700. So opening balance 700. So income statement as a balance of figure is going to be 2700 plus 3500, 3400. Then in addition to the temporary differences relating to the note 2, at 31st March, the carrying amount of trial net assets were 12 million more than their tax base. So closing balance 12 million into tax base is 2400. Deferred tax opening balance 3200. Balance and figure for the income statement is going to be on this side. This one. And this one. And then we have this figure and this figure as well. We have income statement expired. We have income tax charge 3400. Then we have decrease in deferred tax 800. So net charge 2600 is what we are going to have over here, right? Okay. Now we are going to have tax adjustment 2600. We have deferred tax working 6. Not the current tax, rather, let's just say it is income tax. Now, income tax is 2700. Okay. And then with the revaluation gain, the balancing amount is 7800. This is the revaluation reserve. Working 2. $7,800 minus 1560. Right? And this 1560, when deducted from here, is going to be added into the deferred tax. So we have a balance 2400 plus 1560. So all 1, 2, 3, 4 are done, right? So this is what we have over here. Now, once we are done with as far as the posting and everything is concerned, let's just go on to the trial balance and see items one by one. Equity shares $1 each, 50,000. So that's my share capital. No premium over here. Retained earnings already here. Draft profit is over here. 6% convertible loan notes are over here. Property is done. Plant and equipment is done. Accumulated depreciation is done. Trade receivables are done. Other current assets 9300. So instead of the inventory, we have other current assets. which is 9,300. Current liabilities balance 17,700. Balance given 17,700. Deferred tax done. Interest payment. We have already taken into account the interest over here on the effective base. Then the current tax is done over here as well. So we are going to have closing balance 14327. Profit for the year 14327. So the amount is going to be 17,377. So retained earnings 7377. Working 5. Now, no, no. Total assets 138,600. Now with the deferred tax 1560. So we will have 42375. And then we have this balance. Okay. Houston, we have a situation. This is 132Y. What have we missed over here? Ah, revaluation reserve. We forgot to put in the revaluation reserve. 7,800. 1560. 138,600 is equal to 138,600 over here, right? So this is what we have over here. A bit different question over here. Not something, related to the traditional one normally that we come across and we see over here, right? Now we have another question which we are going to start in just like 2 or 3 minutes. We are starting it or resuming in 2 3 minutes. Okay, let's start now. Now we have this another question over here, and now this is from the pastry company. And if you look at this question, we have the cook company over here and the dough company. So the pastry company is the considering the acquisition of a subsidiary in the catering industry. So two companies have been identified as potential acquisitions, and extracts from the financial statements of the cook and the dough company have been reproduced below. We have the statement of profit and loss for the cook and dough, and then we have the extracts from the financial position, and then we have the notes over here 1, 2, 3, 4, 5, and then now the requirement is to adjust the relevant extracts from the dough company's financial statements to apply the same accounting policies as the cook company and recalculate the dose ratios provided in the notes 1 to 5. And then, based on these adjusted accounting ratios, compare the performance of the two companies. Your answer should comment on the difficulties of making a purchase decision based solely on the extracts of the financial position or the financial statements and the information provided in the notes 1 to 5 above over here. Right. So we are going to obviously comment onto it, but obviously speaking, we need to talk about as far as uh, you know the limitations that we normally come across as well, right? So if I go towards the solution, I am going to adjust the relevant extracts. Okay, so both companies are owned and managed. Dough company operates from expensive city center premises selling to local business and the public. So Cook company is a large wholesaler selling to chains of coffee shops. So Cook operates from a number of low-cost production facilities over here. Okay. So we have the point number 2 over here, and this is going to be, we have the revaluation over here as well. So on 1st October, the Dow company revalued its properties for the first time, resulting in a gain of 30 million. The properties had a uh, remaining life of 30 years at 1st October. So Dow company does not make a transfer from the revaluation surplus in its federal excess depreciation. Dow company uses the cost model to account for as far as its properties are concerned. So Dow company and Cook company charge all depreciation to the operating expenses over here. So if I go over here, these are the results of the Dow company over here. So basically, the requirement is to adjust the relevant extracts from the Dow financial statements to apply the same accounting policies of the Cookna. So what we are going to do is we are going to write the adjusted financial statements of Dow company, right? For the year ended 30th September 20x7 over here. Now we have as per question, we'll do the adjustment, and then we have the revised figures as well. Now, here we go. First thing first, we have the revenue, cost of sales, gross profit, operating expenses. Then we have the finance cost. Then we have the profit before tax. Then we have the income tax. And then we have the profit for the year over here. Now the Dow company, 16,300, 8350 over here. The profit is 7950. 4725 and 200. So 3025, and then that's going to be over here. Okay, now we are going to have the workings over here. Now, the first point is basically related to as far as the revaluation of the properties is concerned. So on 1st October 26, the Dow company revalued its properties for the first time, resulting in a gain of 30 million. The property had a remaining life of 30 years on 1st October. Year end is 30th September over here, and 20x7. So we have revalued at the start of the year, right? So technically speaking, we need to adjust for as far as this, revaluation adjustment is concerned. The reason being that the Cook company uses the cost model, and we have to adjust the Dow company according to the, the Cook company over here. So 30 million gain and 30 years life. So it is going to be depreciation reversal is what I'm going to call it over here. Now, the reversal of excess depreciation that we have is going to be 30,000 or 30 million basically, but we are into the thousands, so 10 years. So that's going to be 3,000 over here, right? So the reversal of the depreciation that we need to do over here is going to be 30 million, and the remaining life is 30 years old. Okay, sorry, remaining life is 30 years as well. So it's going to be divided by 30. So it's going to be 1,000 over here. So reversal of the depreciation has to be over here by 1,000. Done? So I'm going to go over here and I'll minus this 1,000 over here. And over here, this is going to be the sum of this and this. And then I will have the figures over here, right? This is going to be like this over here. And this is this is going to be 8350 minus 1,000. This is going to be the sum of these two. This is going to be the sum of these three. And then this is going to be the sum of this. Right? Okay. Now, moving ahead from here, the point number 2, if I go, Cook company charges the amortization of its research and development to cost of sales. Okay. Whereas Dow company charges the same to operating expenses. Okay. So with that, these costs amounted to 1.2 million for Cook and 2.5 million for Dow company. So basically, we have to adjust as far as for the Dow company is concerned, right? We will adjust this amount for the Dow company over here, right? Okay. And why do we have to adjust it for the Dow company? The reason being that the the amortization is for the, okay, Cook company charges amortization of research and development to the cost of sales. Dow company charges same the operating expenses. So for the Cook company it's 1.2, for us for the Dow company this is 2.5 million. So basically we are going to add this 2,500 over here, and then we are going to minus this 2,500 from here because we have to adjust our cost of sales for this, right? Okay, so this will be minus from here, and the 1,000 that we had now, the 1,000 that we had over here for the reversal, this is gonna be coming in over here as well, right? Because if the amortization is charged to the operating expenses, so rather than taking it to the cost of sales, it should have gone over here as well. So over here, I will simply have 8,350 plus 2,500, right? So this is what we are gonna have over here. Done? Okay. Then this 1,000 is not going to show over here. This will be over here. Equals plus 1, like this. Okay, now next point is the notes of the financial statement shows that the cook paid its director total salaries of 110,000, whereas the dough company paid the salaries of 560,000. It doesn't need an adjustment. The following ratios have been correctly calculated in respect of the cook company and dough company for the year ended 30th September 20x7 over here. Okay. So these ratios before the adjustment is concerned, these are calculated for the cook and the dough over here, right? So we have the gross profit margin, operating profit margin, and then we have the return on the capital employed over here. So if I go and calculate now the revised ratios over here, right? We are going to do that. So we are going to have the gross profit percentage over here. Now our gross profit over here is going to be 5,450 divided by sales of 16,300 into 100. So our ratio is going to be 5,450 by 16,300. We get 33.44%. Then we have the operating profit. The operating profit is, yeah, operating profit or the operating margin. Profit margin is, we are going to have this operating profit over here, and this is going to be the amount which is going to be after this, before the finance cost, because this is the profit before interest and tax now. So this is going to be 5,450 minus 1,225 over here. So 4,225, right? So 4,225 divided by 16,300 into 100. So 4,225 by 16,300 into 100. So that's going to be 25.90. Then we have the third ratio, ROS, return on capital employed. ROS is going to be the profit before interest and tax divided by the capital employed. So profit before interest and tax in this case is going to be still 4,225 divided by capital employed is going to be the equity plus debt over here. And in this case, equity, we have equity share is 1,000. Yes. Then we have this 2,600 over here. So that's going to be 3,600. This one, right? And then this is the 5,200 over here. So basically, this is going to be, our profit have increased by 1,000 as well, right? So this is going to be the 1,000 profit increase plus 1,000 shares plus Revaluation, retained earnings are 2,600 at the moment. And then plus the debt. Loan notes are for 5,200 over here, right? I mean, this is the equity portion plus 5,200 for the debt portion as well, right? So this is how we are going to have this. And this 1,000, I'm going to write profit increase via adjustment is 1,000. Equity is 1,000. And retained earnings are 2,600. So that's how we have total equity of 4,600. 4,225 by 4,600 plus the debt 5,200. So this is going to be 4,225 by 4,600, 5,200. So that'll be 43.11% over here, right? So we are going to have the revised ratios over here. One is the cook company and one is the dough company. So we have gross profit percentage, which we have just, have over here. So the gross profit percentage for the cook company is 32.3, right? And then the revised one is 33.44%. Then we have operating profit. So over here, we have 23.3. And over here, we have 25.92. Then we have the ROS over here, 18.8. And over here, we have 43.11, right? So we have these ratios over here as well. Now, so the adjustments, the relevant extracts that we had to do over here are almost done over here. Now, when it comes towards based on the adjusted accounting ratios, we have to compare the performance of the two companies over here. And while comparing, as far as the performance is concerned, what we can do is we can, you know, uh, break down the question into the two halves. This is, overall speaking, one half. This is one half. This is the profit half, and this is the ROS, or this is the return half over here. So technically speaking, I can just simply start by, saying over here that if you look over here, Cook Company operates a number of low-cost production facilities. Cook Company is a large wholesaler over here. Whereas the Dough Company, it operates from the expensive city center premises, selling to the local businesses and the public as well, right? And they are the owner managed. But the scale of the Cook Company is way larger than that of the Dough Company. So let's say that the Cook Company may be a slightly larger company having made more sales and profits during the year. Because if you look over here, the profit, the revenue basically is 21,500, whereas this is 16,300 over here. So the revenue of the Cook Company as compared to the Dough Company is on the higher side, technically speaking, right? So it suggests that initially speaking, when we compare it with the Dough Company over here, So the gross profit margin over here is 32.3%, whereas over here the Dow company is basically starting at 33.4% over here. Just a teeny tiny difference over there. But having kept this in mind, like the higher percentage, this shows that a bit better in this way is basically the Dow company. However, this can be, a bit of a misleading over here because of the accounting policy of the amortization charge, right? Once, obviously, we adjust the accounting policies and all, now we can see that in earlier, the Dow company had a way better, gross profit percentage over here. But when we adjust it, then they are more or less the same over here, right? Uh, just give me a second, please. Okay, so we had this gross profit over here when we adjusted. This is somewhere around more or less equal for the Cook company and the Dow company as well. Similarly, when the this adjustment, Dow company still makes a high gross profit over here, suggesting that relatively high cost properties are still producing a good return over here, right? Now, if we look at as far as the operating profit margin is concerned, in general speaking, this shows that the Cook company is generating a good profit margin as compared to the Roe company of 19.8%. But when we adjust as far as the results are concerned, then surprisingly the tables are turned, and now the Dow company has a better profit position as compared to the Cook company over here, right? So, without further information on the operating expenses, it's going to be difficult to draw too many conclusions about the management of the two companies over here, right? Then, one point which is notable over here is the higher amount of the higher amount of the salaries which are paid by the Doe company over here. Whereas, the salaries paid to the directors over here are just 110, but over here, this is a very massive amount of 560,000. Obviously speaking, if the Doe company's management starts taking the lower level of the salaries, then obviously, the profits, they can really go up as well, right? And alternatively, we can argue that maybe this Cook company has shown its director taking the lower salary so that they can just show that their profits is on the higher side, right? Or make their profit more attractive or more eye-catching over here. Might be possible they have shown their director salaries on the lower side over here, right? So it can go any way around because of the profits, because technically speaking, this is an limitation over here related to profits that we can easily manipulate them, right? And then if we talk about as far as the ROS is concerned, in actual, the Cook company has a ROS of 18.8%, whereas the Doe company just had a ROS of 8.3%, around more than 10% lower than the dough company over here, right? But this situation is completely reversed when the revaluation surplus is removed from the dough's figures over here, right? So basically, when we readjust it, now the dough company is basically giving a loss of 43.11% over here. So this return is not high due to the operating profits or something, but this is something like, because of the better asset turnover over here of the dough company as compared to the cook company, right? It's not that like, just because the dough company is generating more sales or something, or the cook company is on the lower side. The reason is basically that the dough company has a significantly lower equity balance due to having extremely low retained earnings relative to the cook company over here. That is the reason why we have this ratio on the higher side over here. Now, obviously, without having the information regarding the market value of the cook company's properties, it's just difficult to assess that which company is more better to buy and which company is going to cost more to buy. Similarly, basing on any investment decision on a single year's financial statements is difficult as well, because the impact of the different accounting policies is difficult to assess as well. Similarly, from the information provided, it's going to be unclear whether the cook company's directors are taking an unrealistically low salary or whether the two company directors are taking vastly greater salaries than the average as well, right? So obviously, we have to, need the further information to comment onto that as well. And then overall, both companies, they appear to be profitable and have performed well. But looking at the previous year's financial statements of both entities will enable us to make a much clearer investment decision over here. So as well as looking at the notes of the accounts to assess the accounting policies applied by each company, right? So this is what we have overall speaking as far as for the the discussion that we can bring up over here and we can talk about over here. Okay, now moving ahead from here, let's just talk about another question of the treats company that we have, which we are going to start in 2 minutes. Okay, so we have this next question over here now, and that is the Treats Company. Treat Company manufactures the confectionery. The following sector average ratios have been obtained for the year ended 30th September 26. We have the ratios, number of ratios over here. We have the extract of the financial statements of the Treat Company. We have the statement of profit and loss over here. Then we have the financial position over here. Then we have the following points 1, 2, 3, 4. Now, calculate for treats the equivalent ratios for those provided for the confectionery manufacturing sector over here. So these are the treat companies over here. Okay, these are the sector average ratios over here. So we have to calculate it for the treat now. So I'm going to go over here. First thing first, I'm going to calculate the ratio. So first ratio is going to be of the ROS. And the ROS, return on capital year and employed, profit before interest and tax divided by capital employed. So that's going to be profit before interest and tax. If I go, this is a profit before tax 6137. So we are going to add this 1329 in it. So 6137 plus 1329, I get 7466 over here. So that's going to be 7466 divided by capital employed is the equity plus debt. So if I go over here, my equity is going to be 25,968 and the borrowings are 33,621 over here. So 25,968, 25,968 plus this was 33,621 into 100. So 7466 by 25968 plus 33621. So this ratio is going to be 12.53% over here. Second ratio on the go is the net asset turnover. The formula is sales over net assets. Now, the sales are 214,553 divided by net assets. Net assets are going to be the equity portion, and that is 25,968 already calculated. So this is going to be 214,553 by 25,968. So that's going to be 8.26 times over here. After the net asset turnover, we have gross profit margin over here. That is gross profit over sales into 100. Gross profit is going to be 106,544 divided by sales are 214,553. 544 by 214,553. So that's going to be 49.66%. Then I have the current ratio. The formula is current assets over current liabilities. So current assets 47,996 divided by current liabilities 5391. So that's gonna be 47,996 by 5391. So 0.95. 0.95 ratio 1. After that current ratio, we have inventory turnover. That's going to be inventory by cost of sales into 365 over here. So the inventory is 3393 by cost of sales, and cost of sales is 108009 into 365. 108009 into 365 is going to be 103 days over here. This is with ratio 1 and this is in percentage already. After the inventory turnover, we have after the gross profit margin, we had this operating profit margin, which I forgot to calculate. Oops. Let's have the operating profit margin as well. That is operating profit by sales into 100. So operating profit from ratio 7466 by sales 214553 into 100. 7466, no, yeah, by 214553, we get 3.48%. Okay, so after the inventory turnover in days, we are going to have now the gearing, that is debt over equity ratio over here. And the formula for the gearing is going to be 33,621 divided by 25,968 into 100. So this is going to be 33,621 by 25,968. So that's going to be 129%. Okay. After the gearing, we have the receivables collection period. That is receivables 17603 by sales 214553 into 365. 17603 214553 into 365. So that's going to be 30 days over here, right? Okay, so these are the points over here that we had to calculate for as far as the ratios are concerned. And now the second part is to analyze the performance and the financial position of the treats company in comparison to its sector averages over here. Okay, so if I go up, this is the return on capital employed, 28.8%, whereas this is mine at 12.53 of the treats company over here. So if I talk about from the ROS point of view, I can simply say that the ROS of the treat company is much lower than the industry average. And this is a result of a low or a very low operating profit margin, as the net asset turnover over here is above the industry average. Because if I see this is 2.4 times and this is way too up, 8.26 times. So the only reason left behind for the ROS being lower is because of the lower operating profit margins over here that we have, because the operating expenses are too high with the cost of sales as well. So the operating profits, the operating expenses, they have cut short as far as the profit from the operations are concerned. Similarly, if I go into the gross profit margin over here, I can simply say that the gross profit margin of 49.66% is almost making it there up to as far as for the industry average is concerned, right? Because overall speaking, this is slightly below than the market average. This is not surprising, as the trade company sells goods to the supermarkets, which are likely at the lower margins than the goods directly sold to the public is concerned. Okay. Now, as far as the we have just talked about as far as the lower margins are concerned, because the treats company is selling to as far as the the supermarkets are concerned. So that is why the margins kind of onto the lower side. Then if we talk about as far as the operating profit margin is concerned, ours is just at 3.48%, whereas the industry average is at 12% over here, right? So this again shows that the operating profit being significantly below the industry average. This is something which is unclear at the moment because of the facts which are given over here, that what is the cause of this, right? But it does suggest that the cost control issues, as this is going to be much worse than industry average as compared to the difference in the gross profit margin is concerned. So this is something we have highlighted already earlier, that our operating expenses, they are really very high. So the further information is required why this, the operating expenses are way too high over here. Then we have this current ratio, which is standing at 0.95 ratio 1. Now, if we come down towards as far as our inventory and the receivables are concerned, if we look over here, these are for 30 and 17 over here. And now we have this overdraft for the point number 3 over here. And if I go into the point 3, Treats company paid a dividend of 7.14 million during the year, despite the concern raised by some directors over the existing overdraft. So even then, that Treat company gave off as far as the dividend in 7.14 million is concerned, despite of the fact having this overdraft figure over here as well. Now, for as far as the current ratio is concerned, this is significantly lower than the industry average, and this is likely because of the significant overdraft which the trade company uses for the working capital management over here. So it's appearing over here that lots of cash is also tied up over here with the inventories as well, because our inventory holding days are 103 days, whereas that of the industry is just 25 days. So it means we are almost taking around 4 times the time average, taken by the industry as a whole is concerned. So it shows that, you know, it shows that maybe most of the items it has to be write down now. We have to write off some because of the perishable nature as well. Items might get expired or something as well, right? So this is something which is an alarming situation over here as well. Similarly, the receivable holding period, collection period is concerned, we have a 30 days over here, whereas that of the industry is 15 days over here as well. So technically speaking, this is twice that of the industry is concerned, because this is something which can be because of the supermarket contracts that we have maybe, and which demand comparatively as compared to the other customers a longer time period as far as doing the payment and everything is concerned. So this can be one of the reasons, or this can be the one of the main issues over here as well, right? And then overall speaking, as far as the gearing is concerned, we have 129% over here, whereas the gearing of the industry average is just at 43% over here. So gearing ratio is significantly higher over here as well than the industry, which is a significant concern, particularly in the light of the treat company's cash position as well, because you are suffering from the cash point of view as well. Then you have a higher gearing ratio over here as well. So technically speaking, it needs to be the investment in the non-current assets, but it's doubtful whether it's possible to raise the debt to finance this or not, right? So obviously this is going to be an issue over here. So overall speaking, the results are a mixture over here, but again, the further information is required to fully investigate the performance and the financial position of the trade company is concerned. And further information is also required for the composition of the operating expenses as well, right? Neither the inventory nor the cash position looks very strong in comparison to as far as the industry is concerned. So this is something that the company is struggling, at the moment over here, right? So these are the general points that you can add up over here, right? Okay. Now we are going to have the next question over here, and that is going to be of the consolidation now. So we are going to start this question in 2 to 3 minutes. Let's have a break, and after that, we'll start this question. So let's start this question now. This is the Plester Company. 1, 2, 3, 4, 5, 6. Prepare the consolidated statement of the financial position of Plester Company. So we are going to start over here. Here we go. First thing first, this is all clear that from every section C type question, we have learned this one thing that we have to create a format first. So this is going to be Pallister Group Consolidated Statement of Financial Position as at 30th June 2025. Okay, put up the currency signs, then assets, non-current assets, leave 4 lines and write current assets, inventory, receivables, bank, and then total assets, then equity and liability, share cap, share premium, group retained earnings, non-controlling interest, non-current liabilities, and then current liabilities. And then we have total equity and liabilities over here. So after this, some underlying cosmetic arrangements. Then we are going to have the workings over here. Working one, the group structure. Now we have Pallister. Then we have structure over here. Now we have working two, summary of net assets of structure at acquisition date, at reporting date. So we have share capital, share premium, retained earnings free, total. Then we have working three, group retained earnings. We have Pallister and structure. We have balance given over here and then post over here as well. Then we're going to have the working four over here, right? And I'll highlight this point as well. So these are the basic workings that you have to create in every question before instead of going and jumping and solving it as concerned. Now we'll start this question. On 1st January 2025, Leicester acquired 75% of the structure's equity shares by means of an immediate share exchange of 2 shares in Plester for every 5 shares in Stretcher. The fair value of the Plester and the Stretcher shares on 1st January were $4 and $3 respectively. In addition to the share exchange, Plester will make a cash payment of 1.32 per acquired share, deferred until the 1st January 20x6. And Plester has not recorded any of the consideration for the Stretcher in its financial statements, and Plester's cost of capital is 10% over here. Okay. Now I'm going to go over here into the cost of investment over here. First thing first, I have a share exchange. I have acquired 75%. So I'll write this. This is the 75% holding over here. And this is by means of a share exchange of 2 shares in Palestra for every 5. And 20 million is the value of the shares over here, because $1 each, so 20 by $1 is 20 million shares over here. So we are going to have 20 million shares multiplied by 75% into 2 shares in Plester for 5. So it's going to be 2 by 5 multiplied by the share amount of the Plester is $4. Right? So this is what we are going to have over here. So this will be 75% into 2 by 5 into 4. So 24,000 is going to be over here. Then we have the deferred consideration over here, 20 million shares into 75% acquired, and then we are supposed to pay him what? 1.32 per acquired share. 1.32 acquired share into 10% is the cost of capital. So 1.1 whole raised to power minus 1. So 20,000 into 0.75 into 1.32 into 1.1 whole raised to power minus 1. 18 million over here as well. So our total cost of investment is going to be 42 million, which we have to record. Now, as far as the recording of share exchange will be debit cost of investment with 24 million, credit share capital, credit share premium. Now, we have $1 each, right? And we have issued the share at $4. So $1 is going to be over here. $3 are going to be over here. And then if we look the number of shares which we have issued into 2 by 5, 6,000 shares have been issued, right? So 6 is going to be over here. 18,000 is going to be over here. So 24, 6, and 18. This is what we are going to have as a double entry. Now the share capital and share premium are supposed to be recorded in the account. So I'll go up. Share capital is 6,000. That's going to be 1, 2, 3, 4. So already my share capital is 20 million plus 6 million. Share premium, I don't have any, right? I have the other components of equity, 4 million. So the share premium, this is 18 million. So I'll write 18 million over here with the reference of working for. So I have other component of equity as well. Okay. Then after the recording share exchange, we have this deferred consideration regarding a deferred consideration will be cost of investment debit with 18,000 I'm going to credit deferred consideration with 18,000. Then I will have the unwinding of discount. I got the company on 1st January. The year end is 30th June. So 6 months gone. So I'm going to take up the 6 months unwinding of discount over here. 18,000 into 10% into 6 by 12. 900 over here. So that's going to be debit retained earnings. 900 credit deferred consideration with 900 over here. Right? All right. So now time for recording. I'm going to go over here. I'm going to write unwinding of discount. 900 deducted from here. I'll go over here in my current liabilities, and this is going to be deferred consideration because after 6 months I have to pay. So this was 18,000 plus 900 now, right? Okay, done? Done. So I've recorded my share issue. I've recorded my deferred consideration. I've recorded my unwinding of discount. So everything done with this first part. Now, the summarized statement of the financial position of the two entities is given below. So before this point, I am going to see the point number 1 over here, which says stretcher business is seasonal and 60% of its annual profit is made in the period from 1st January to 30th June. Okay, from 1st January to 30th June, we have the 60% of the profit over here. So the profit is 6,000 over here. So in the post-acquisition period, this is going to be 6,000 over here. So I'm going to go over here. The total profit is 24,000 over here. How 24? 14,000 plus 10,000. So this is 24,000, right? So if 24,000 is total, 16,000 is post. So the pre is going to be 18,000 over here, right? So we are going to have our retained earnings like this. Then the equity component, we have 20,000, 20,000, nothing for the premium over here. Done? Okay. Now, point number 1 done as well. At the date of acquisition, the fair value of the stretch and net assets was equal to their carrying amounts with the following exceptions. Okay, so we have the exceptions now that we need to take into account. One is the fair value of the stretch's financial asset equity investments carried at 6 million was 7 million. Okay, so we are going to have equity investment carried at 6 million was having a value of 7 million. Then at 30th June, the fair value of the financial assets equity investment of the plus and such was 13.2 and 7.9. So at the date of acquisition over here, the fair value investment, this is at 6 million over here, and it says the value was 7 million over here. So I'm going to go over here. I'm going to write fair value investment by 1 million over here. And then at the year end, this value has increased to 7.9. So for the 9 is increased, so that's going to be 1900 over here, right? I mean, 1000 for the original increase and then 900 for the 6 months increase over here, right? So this is going to be over here. Then I'm going to go into my non-current assets. I will simply write fair value investment over here. And my values are 13.2 and 7.9. So 13.2 and 7.9 over here, right? And with the corresponding half, I am going to give the share over here, right? And gain on equity investment over here in number 5. This is the 13.2. This is at 11,500. So 13.2 and 11,500. That's 1,700 gain over here. And the post-acquisition period, The gain on the investment is 900. So for stretcher, I'm going to bring it over here at 900. But for the Plister, this is going to be 1700 over here. And I have written the revised values over here. Done? And the ones over here as well. Then, stretcher owned the rights to a popular mobile phone game. So at the date of acquisition, specialist value estimated the rights were worth 12 million and had a remaining life of 5 years over here. So we have the game rights over here. The game rights are for 12 million. And then we have excess amortization for 6 months, 12 million by what the life is 5 years. So 1200 is going to be the excess amortization over here. I have this excess amortization of what? 1200? Yeah. Of 1200 over here. Then I'm going to go over here. I'm going to write game rights. That's 12,000 minus 1200 over here. Right? Straight away, straight working. Then, point number 3. Following an impairment review, consolidated goodwill is to be written down by 3 million. Okay. Consolidated goodwill is to be written down by 3 million over here. So we're gonna write it down when we are gonna go over here. Then, point number 4. Pelister sells goods to Stretcher at cost plus 30%. Plus, Stretcher company had 1.8 million of these goods in inventory at 30th June, which had been supplied by the Pelister. Then, in addition, on 28 June, Pelister processed the sale of 800,000 of goods to Stretcher, which Stretcher did not account for until their receipt on 2nd July. So the in-transit reconciliation should be achieved by assuming the transaction had been recorded in the books of the Stretcher before the year end. And then at 30th June, Pelister had trade receivable balance of 2.4 million due from Stretcher, which is different from the equivalent balance of the Stretcher books due to the sale made on the 28th June. We have 3 points over here to talk about. 1, the intercompany transaction and the unrealized profit. Intercompany transaction and the cash in transit or the goods in transit, and then the intercompany balances over here. So we are going to deal with them one by one. Number 1, working 5. That's going to be intercompany transaction. First thing first, we have sales, cost, and profit over here. Now, Stretcher had, let's just sold goods to cost plus 30%, and he had 1.8 million in inventory, which had been supplied by Blister. So 1.8 million is the sales value over here, and 30% is the cost. So the amount of the profit is going to be 415 over here. So unrealized profit is 415, right? So with this, straight away just do the adjustment over here. Plaster has sold the goods to Stretcher, na? So I'm gonna go over here. I'm gonna write unrealized profit working 5, and the amount is 415. I'm gonna minus this 415 from here. I'm gonna go into the inventories. I'm gonna write 17,000, 15,400. This is the parents, this is the subsidiaries, and then we have to minus the 415 from here. One adjustment. Second one, the goods in transit. I'm going to write goods in transit now. And that is let's process the sale of 800,000 over here, right? So if I go with this 800,000, Pallister send the goods to stretcher. So we have sales, cost, and profit over here. And the amount is 800,000. So again, 130, 130. So basically, technically speaking, the amount of the profit is going to be 800 by 130 into 30 at 185. So unrealized profit in goods in transit is 185. So I will again debit, when the transaction is going to complete over here, I'm going to debit the retained earnings with 185, and then I'm going to credit the inventory with 185 over here. So 415 plus 185, let's just do the total. Unrealized profit 185 plus 415, 600. So I'm gonna minus 600 from here, 600 from here. Then when the goods are gonna be received by stretcher, then debit inventory with 800, credit payables with 800. Eliminate the intercompany balance. So first I am going to add 800 over here. Payables, current liabilities balance given. Okay, so I'll say the balance given. 25,800 plus 18,100 plus 800. Okay, this plus 800. Now eliminate the intercompany balance, and that's going to be debit the payables with, what is the intercompany balance? 2.4 million. And credit the receivables over here. So payables minus 2,400, receivables 14,300 plus 10,500 minus 2,400 over here. Right? I hope it's clear. Now, point number 5 already done. Then the Prestes policy is to value the NCI interest at the fair value, the date of acquisition. For this purpose, the value given of the stretches assets may be used. So this was working 5. I'm going to go over here with working 6, fair value NCI. That's going to be 20 million shares. 75 is mine, so 25 is there. So 25% into the value share of the stretcher is $3. 15,000, right? Okay. So this is what the whole picture is about. Now I'm going to go over here. Let's do the totals. Total net assets are 51 here. 56,700 over here. Percentage acquired 75. Rather than saying acquired, let's say percentage holding. Yeah, that's much better. Now, Net assets acquired. So this into this. Cost of investment, 42,000. So we have the goodwill group. Then we have the fair value NCI, 15,000 less net assets at acquisition into 25. So goodwill NCI, 2250. Total goodwill, 6,000. Less impairment. Written down by 3 million. Right? So 3 million is what we have to write down as far as the goodwill is concerned. So net goodwill 3 million. So I'll go over here. Goodwill NCI 2250 plus impairment 3,000 into 25%, and then 3,000 into 75%. Goodwill impairment. Right? So we are going to have total NCI 15,675 over here. This is the NCI working to 15,675. There's going to be the goodwill, which is 3 million, and now the group retained earnings. Percentage holding 75%. So Palestina, the retained earnings are 26,200 plus 24,000. So the total 52,425 over here. So this is the group retained earning 52,425. Over here, this is 26,000. Right? Other components of equity, let's see. We have 4,000 over here as well. So we'll have the amount over here. Now let's go at the start. Non-current assets, property, plant, and equipment, 55 and 28,600. Property, plant, 55,000 and 28,600. Okay, then what about the bank? 2,200 and 1,600. Now let's just go forward. 13,200, 7,900, 12,000 minus 1,200, 55,000, 28,600. And then we are going to have its total outside. And then we have 17,000, 15,400 minus 600 minus plus 800. So 32,600 is going to be there. Then we have 14,300, 10,500, and minus 2,400, 22,400, and then 2,200 plus 1,600. 177,300. This 100,425. We don't have any known current liabilities over here. The current liabilities are given, and we have accounted for these over here. So this is going to be 18,900. This is going to be 25,800, 18,100 plus 800 minus 2,400. $177,300. Right? So this is what we have over here. Okay. I hope it's clear. Now, we'll start another question within 2 or 3 minutes. Okay, let's start now. Now I have this pyramid question because we are done with the blister. And before that, we were into the ratios. So the pyramid question, the requirement of the question, I'm going to straight away jump. Prepare the consolidated statement of financial position. So let's start with the format as we have always been. I'm going to box it up, merge, merge, pyramid group, consolidated statement of financial position as at 31st March 2022. Non-current assets, current assets, total assets, equity and liabilities, share capital, share premium, group retained earnings, non-controlling interest, non-current liabilities, and then, oops, we are not left with the current liabilities over there. Then we have total equity and liabilities over here. Okay. Underline. Working on group structure. We have pyramid, we have square. Working to summary of net assets of square, net acquisition date, at reporting date. Share capital, $303 total. Right? Then group retained earnings, pyramid, square, balance given, post. Now, let's just go at the start of the question. On 1st April 20x1, exactly 1 year ago, Pyramid acquired 80%. So we have this 80%. Equity shares by means of an immediate share exchange and the cash payment of 88 cents per acquired share, deferred until 1st April 2022. Okay. Pyramid has recorded the share exchange, but not the cash consideration over here. So if I go over here, we have the square and share exchange has been recorded over here. So we have to just incorporate the deferred consideration over here. So I'm going to go over here. I am going to leave certain lines over here, 7, 8 lines. Then I'm going to go and work in for cost of investment. So we have this share exchange. That's going to be 24 million. Then I have this consideration. Equity, 10,000. I have acquired 80%. Into, I'm supposed to pay 88 cents. Into, I'm paying it 1st April 2022. That is the start of the next year. So 1 year later. Into 1.1 whole raised to power minus 1 over here. So that's going to be 80% into 88 into 1.1 whole raised to power minus 1,6,400 over here. So total consideration is 30,400. As far as the recording is concerned, we are going to debit the cost of investment with 6,400. We are going to credit the deferred consideration over here with 6,400. Then we have unwinding of discount. 6,400, 10% is going to be 640. So we'll debit the retained earnings with 640. We'll credit the deferred consideration with 640. So I'm going to go up in my current liabilities basically because I have to pay it the next day. Deferred consideration is going to be working 4. So that's going to be 6,400 plus 640. Right? Okay, and then I'm going to have this unwinding of discount working for 640 is going to be deducted from here as well. Okay. Done. Then let's see, what do we have next? We are done with this point. Now let's just go down. And when we go down, let's see. The share capital is 10 million. I'll write the 10 million over here. No premium. As far as the retained earnings are concerned, I got it on 1st April. This is 31st March. So pre-acquisition retained earnings are 18,000. This is 18,000 plus 8,000. And the posts are going to be 8,000 and the total 16,200. 14,000. So we have this whole basic information over here. Now, the following information is relevant. At the date of acquisition, Paramount conducted a fair value exercise on the Square's net assets, which were into their carrying amounts with the following exceptions. Number 1. An item of plant had a fair value of 3 million above its carrying amount at the date of acquisition. It had a remaining life of 5 years. Ignore the DAF tax relating to it. So we have a fair value of plant. $3 million. Excess depreciation. So this is 3 million over here. Excess depreciation is 5 years by 5. Excess depreciation here. Excess depreciation 600 over here. We'll go here, plant and equipment. 38,100. 28,500 minus 600 over here. Done? Then we have the second point. Square had an unrecorded after-tax liability of 1 million, which was unchanged at 31st March. So we were supposed to record an after-tax liability, which it had not recorded. So I will go the after-tax liability 1,000, 1,000, and this deferred tax liability, going to be recorded into the liability half as well. So non-current liabilities, deferred tax, I have 16,500 over here, and this is 4,000. So I'll write the deferred tax separately over here. 1,000 over here, right? Parameters policy is to value the non-controlling interest at the fair value, the date of acquisition. For this purpose, the share price of 3.5 each is the representative of the fair value of the shares held by the NCI over here. Okay. So we are going to have this fair value NCI. They have the 10 million shares, I guess, right? Yeah. 10 million shares into, we own 80%. So this is going to be 20%. This is going to be 3.5, not 4, 3.5. 7,000. Now, after this, we have point number 2. Paramit sells goods to Square at cost plus 50% below is a summary of the recorded activities for the year ended 31st March 2022. So, sales to Square, purchases from Paramit. So it's showing that, it has made the sales to Square, and Paramit is showing that, it has purchased from Square as well. And then the point is, Paramit sells Squares to cost at cost plus 50% below is the record. Then on 26th March, Paramit sold and dispatched goods to Square, which Square did not record until they were received on 2nd April. Square's inventory was counted on 31st March and does not include any goods purchased from Paramit. Okay. And then on 27 March, Square remitted a payment of a cash payment which was not received by the Paramit under the 4th, and this payment accounted for the remaining difference on the current account. Okay. Now, we have the difference between the two at 1,500. Intercompany transaction. Sales cost profit. So the difference is 1,500. This 1,500 is difference between these two, 14,500 and 16,000. And we have 50% cost plus 50%. So the cost is going to be 100%. This is going to be 50%. So this is going to be 150%. So the profit is going to be 500 over here, right? And this whole amount is going to be the unrealized profit over here. So we are simply going to debit the retained earnings with 500, credit the inventory with 500 over here. So these are the sales by the Paramit. So I'm going to go over here, unrealized profit 500. I'm going to go over here in the inventory 13,900. 10,400 minus 500. And then after that, we have goods in transit that we have to record. And the goods in transit, okay. Dispatched goods to Square, which Square did not receive until the 2nd April. Square's inventory was counted on 31st March and does not include any goods. So, technically speaking, okay, that's going to be the goods in transit for the 1500 over here, no? These one, because these are the last one which have been sent and have not been received. So I'm going to debit the inventory, credit the payables with 1500, right? Then I have Pyramids receivables and Squares payable 4400 and 7700, right? So the difference between the two, 2700, right? So the difference between the two is 2700 over here. So remaining difference in the current accounts. So 2700, this is the inventory balance over here now. So 2700 minus 1500 is going to be the cash in transit over here, which is 1200 over here, right? So I am going to debit the cash with 1200. I am going to credit the receivables with 1200, and then the intercompany balance debit the payables and credit the receivables, right? And the amounts, okay, I have to calculate. So the intercompany balance at the moment, I mean, if I look over here, that's gonna be 4400 is over here. This is the receivables, right? And this is the cash in transit, which it has not received. So technically speaking, 4000 minus 1200 is 2800 over here. But no, sorry, it's 4400. Okay, it's 4400 over here. 3200 is going to be the balance over here. So this is the whole recording that needs to be done. We have recorded this one. Now we have to record just cash in the receivables over here. So I'm going to debit the cash over here. 9400 and 600. 1200 over here. In the receivables, I'm going to go 11,400. 5500 minus 1200, right? And then payables, debit, and receivables credit 3200. Minus 3200. Balance given 95 and 5000. 3200 over here. Right? All right. And we have recorded this payables over here, this goods in transit for the inventory. No, we have not recorded. So we have to record this as well. Plus 1500 here. Plus 1500 here as well. Okay. Now, moving ahead from here, the other equity investments of Paramount are carried at their fair values. At 31st March, these had increased to 2.8 million over here. So let's have this working over here. Equity investment. We have the carrying value, 2000, fair value 2800, gain on investment 800. 2800 working 7 over here, right? Now, all done. Time to do the balances. We have 30,000 over here, 37,400 over here. Percentage holding, 1820. Net assets acquired, 24,000 over here. Cost of investment, 30,400. Goodwill Group, 6,400. Fair value of NCI, 7,000. Less net assets acquisition, 6,000. Goodwill NCI, 1,000. Total goodwill, 7,400. Then this into this. Goodwill NCI, total NCI, 8480. This is working to 7,400. Then this is the NCI. No, sorry, group share. Not NCI, group share. Total group retained earnings are 35,780. Done? Okay. Now, let's go at the start. Property done, investments done. Property done, investments done. Current assets, inventory, receivables, bank. Inventory, receivables, bank done. Share capital, 25,17,600. The premium. Then NCA done, non-current liabilities, 16,500 and 4,000. Balance given, 16,500 plus 4,000. And then current liability 95 and 5. Done. Now let's just do the totals. 38,100 plus 28,500 plus 3,000 minus 600 over here. 69,000. I'm going to bring it out. That's going to be 79,200. 25,300. 12,500. 11,200. So total assets 128,200 over here. 78,380. 8480. This is going to be 21,500. This is going to be 6,400 plus 640. This is going to be 9,500, 5,000 minus 3,200 plus 1,500, 12,800. That's gonna be, and then 128,200 over here. All right. Okay. So this is what I have over here for you. I hope it's clear. Done. Now we are going to stop over here for the day. We are going to meet in the next class, and then we'll cover up with those as well. I mean, the remaining ones, right? So practice a lot and a lot. And if you come across any problem or something, do let me know. I'll be more than happy to assist you and guide you in this, right? So till we meet again, it's time to say bye. Take care of yourself, your family, your friends, and the people around you. Have a lovely time ahead of you as well. And take care. Bye-bye.